Hallo und herzlich willkommen bei dpnTV. Schwellenländeranleihen rücken nach einer langen Phase größerer Kapitalanflüsse zurzeit wieder verstärkt in den Fokus der Investoren. Gleichzeitig blicken manche vor dem Hintergrund vor Sorgen vor Deglobalisierung und geopolitischen Risiken kritisch auf die Assetklasse. Ich freue mich daher, mit meinem Gast Robert Nelson auf einen spannenden Markt heute zu blicken. Robert, thank you for being here.
Pleasure. Thank you for having me.
You're Senior Vice President, Portfolio-Manager and Research Analyst for Franklin Templeton's Fixed-Income-Team in London.
Correct, yep.
As our first segment, I would like to talk with you about the emerging market debt segment in general as a whole. Maybe you can provide us with a quick recap. What are the main drivers currently behind the investor sentiment?
It's been an interesting few years, as you said in the intro segment. Actually, 2022 was the last really bad year we had for the asset class, and that was largely because of the sharp increase in inflation and interest rates that coincided with the Russian invasion of Ukraine. Since then, the last 2 years have actually been quite positive from a total return point of view, mid to high single-digit returns for hard currency EMD. And this year actually looks like it's going to be even better, potentially double-digit percentage returns. So despite all the noise that we have in the market, all the headlines, whether it's tariffs, geopolitics, whatever you may care to imagine, performance has actually been pretty good. And a lot of that has to do with the flows that we've seen coming into EMD. So that obviously leads to the question, why is this capital flowing into emerging market debt? And I think the story there is a combination of the fundamentals of the asset class itself, which are very strong, default rates relatively low and expected to remain so, but also these macro dynamics that we see, a weaker dollar, lower US Treasury yields and loosening financial conditions. I think also a desire on the part of some investors, particularly in this part of the world, to diversify away from the US is part of the story as well. And all of that has led to increased flows into EMD. Actually, this should be the first positive year of flows in 4. We've had 3 very tough years on a flow point of view. So the mood in EMD is positive. It's surprisingly positive, perhaps, given the amount of news flow we have. But generally speaking, I think we as a team expect those positive dynamics to continue. As I said, they're underpinned by good, solid fundamentals, and so we expect a fairly solid end to the year as well.
Were you surprised that the asset class remained so resistant to the pressures?
To an extent, yes. I mean, going back to before the US election, October last year, we thought through some of the possible outcomes and what that might mean for our asset class. Tariffs was an obvious kind of focus of that research, along with US foreign policy and other elements of US governmental policy. And our thought was that the tariffs that we've actually now seen come to pass, potentially double-digit percent tariffs globally, really, with higher tariffs in China as well. That was perceived to be quite a negative kind of outcome for EMD at the time. But we've managed to kind of come through that with spreads, albeit initially spiking on the Liberation Day announcement, but since then, really grinding consistently tighter since then. And even the news that has come through on Iran or the occasional tariff announcement on a specific industry or sector hasn't been enough to derail the general trend, which has been spread tightening and positive total returns. So I think it has been partially, a little bit more positive than we expected. Part of the story is also around the growth outlook.
Yes.
And that has surprised a lot of people. It surprised us, I think, that developed market growth has held up and that EMs have been as resilient as they have. Yes. So there's an element of the fundamentals remaining very strong despite all the noise around tariffs.
Can you give us a sense of how credit fundamentals and default risk in EMD today, and are markets adequately pricing in those risks? Would you say that?
Yes. Yeah, so two parts to that question. The kind of fundamentals, I think, generally strong and actually improving, arguably. One indicator you can look at for that is the ratings migration ratio, so the upgrades to downgrades of EM sovereigns. And that in the most recent quarter has moved to a very positive level. So we're seeing more sovereigns get upgraded than downgraded. Within that number and within that ratio, we have some high yield countries moving towards IG, which is very healthy, the likes of Paraguay and Serbia. We have some more distressed countries, coming out of that kind of post-COVID restructuring phase that we saw, and gradually improving their ratings as well. There are obviously some countries going the other way and seeing a deterioration, but on the whole, the direction of travel is positive. And when it comes to defaults specifically, as I said, most of the COVID era defaults that we saw and the restructurings are now done. So Sri Lanka, Zambia, Ghana have all been sorted out now. There is still a small list of residual names that remain unresolved, Lebanon and Venezuela being the two obvious ones, and they could be with us for a while. But I think what we're looking at now is an asset class that is cleaner because we've been through this restructuring process, and most of that is now done. So from a fundamental perspective, I think the signs are good. When we look at external accounts, liquidity, solvency of sovereigns, most of these indicators are strong and moving in the right direction. The one area that I think causes us pause for thought is on fiscal, particularly in certain parts of the world, notably Latin America. Colombia and Brazil often come up, particularly as it pertains to the election cycle, which is coming around again in that part of the world. So fiscal's worth watching, but on the whole, I think the general trend is pretty positive for fundamentals. And sorry, there was a second part of your question. Is it adequately compensated?
Yes.
That is a more difficult question, I think. Spreads globally in fixed income are tight. It's very difficult to argue with that. I would say that in EMD, we see them as less tight compared to their historic ranges than we see in some other asset classes. So there's a bit more value there, particularly on the high yield side. So we do still find value down in the kind of double B, single B part of the market. But one thing we would observe is that investors now are not just focusing on spread, there's more focus on nominal yield. And so that nominal yield, that return that you should get over the course of a year, also offers you protection against a rise in interest rates or spreads. And the break-even for EMD at the index level is above 100 basis points now. So there is quite interesting dynamic here where people are moving money into EMD, we think, because it offers that protection against an unexpected spike in treasuries or in spreads.
Still, I'd like to address this fear of deglobalization. We can't ignore that we have big conflicts in the world that lead to that countries are changing the way they trade. How does that? What's your take on that?
Yeah, we would push back on the term deglobalization because what we have observed is a rewiring of the global trading setup, and that's been going on for a while now. I think accelerated by the tariffs that are now in place. And while goods trade has flatlined, services have actually continued to rise. So there are a few different things going on. Our observation is that in the emerging world, there's been a lot of refocus away from countries like the US and developed markets to other emerging markets. So far from being a very negative influence on the outlook for EMD, we actually see some pretty good reasons to be positive. And as a kind of corollary of that, or as a kind of side effect maybe, on the corporate side, we've seen companies beginning to look a bit more to their local markets for funding. And we can kind of link that up, I think, a little bit with the reduced need for dollar financing related to that kind of changing trade pattern, if you like. So there's some interesting things going on. But I wouldn't say it's a particularly concerning development for us.
Okay, that's actually a great point. Maybe we can go talk about corporates within the emerging market. That segment. How would you describe emerging market corporates within the broader universe of the asset class? What makes them so special?
It's EM corporates are kind of the new kid on the block, if you like, for EMD. The asset class really took off post global financial crisis. Prior to that, there was a very, very small amount of EM corporates outstanding, and they really did grow as an asset class in the intervening years. It's now an asset class that is around $1.4 trillion in terms of market value, which is sizable. To equate that to developed market kind of equivalents, it's roughly the same size as the US high yield market if you look at the indices, and much bigger than European high yield. So it's grown a lot. It's large. One of the key misconceptions about the asset class is that it is somehow layering more risk on top of emerging market sovereign risk. And we try and correct that misconception, because when you look at the asset class as a whole, the average rating, for example, is BBB flat, if you look at the index that we do. And that compares to the sovereign index that we look at, which is BBB minus. So, a notch above the sovereign. So part of that is to do with the geographical composition, but it's also to do with the specific companies and the sectors that are represented. Around 70% of EM corporates are investment grade, if you look at the ICE index. So this idea that it's a very risky form of EMD, a kind of more risky version than the sovereign part, is wrong. We think it's actually a lower beta part of the market. And that's also a reflection of its shorter duration. So within the EMD world, EM corporates tend to have a shorter duration than sovereigns, for example, when you look in their totality. So EM corporates, instead of being this kind of turbocharged risk kind of sub-asset class, are actually lower beta. And they provide really excellent diversification, we think, to a blended strategy. If you have sovereign investments globally in emerging market debt, being able to invest in EM corporates provides wonderful opportunity to be able to look sometimes in different countries, but actually more often just in different industries and sectors that provide you different exposures, diversified exposure to different risk factors. So that's the main advantage, I think, of investing in EM corporates.
So I'd like to maybe learn more about your approach, because still there are risks like intransparency. How reliable are the data that you get? How do you assess, or how do you manage those risks in your process?
Yeah, it's important, I think, to recognize that the EM corporate world is starting perhaps from a different starting point to maybe European IG or European high yield. So we need to kind of bear that in mind and maybe hold the sector or the asset class to a slightly different standard. It certainly affects the way we approach our analysis. We pay a great deal of attention to cash flows and governance. Experience has taught us that on occasion fraud does happen in the asset class, so we need to be wary of that and looking for the signs of it. But the answer really is building well-diversified portfolios, I think, and making sure that your concentrations are understood and rewarded, so that if something does go wrong unexpectedly, and we've been involved in EMD since the mid-90s, we've been through a few cycles, and have learnt sometimes the hard way that things do happen unexpectedly. So that diversification point is vital, really, to guarding against those unexpected shocks. But yeah, governance is an issue that we try and focus on. We try and encourage improvement through engagement. That's a big part of our ESG process. But ultimately, it needs to be rewarded in the risk premium.
I would like maybe to zoom out again. When you look at supply, demand, refinancing conditions, how healthy is our emerging market corporates right now?
Well, it's been a very good year so far from a gross supply standpoint. around $400 billion of new bonds issued. And the composition of that new issuance has actually been quite interesting. A much diminished role of China within that 400 billion. Part of that is the absence of China property companies, but also I think a lot of Chinese firms, private and state-owned, looking more domestically, to my point earlier, at their local market to be able to refinance onshore at lower interest rates. So gross supply has been pretty substantial, but the mix has been more varied, which I think is positive. From a net point of view, so that's gross supply, but then taking into account the bonds that have been repaid, the bonds that have been called, or where there's been some other tender of some sort, that number is much more balanced and closer to zero. And that gives us some comfort that although the gross number's high, the market isn't being swamped by new bonds. So the supply side's looking good. On the demand side, we've seen this rebound in flows back into EMD in general, which has been helpful and supportive. And when we look specifically at EM corporates, often the data's a little bit patchy, but we see, from example, the order books for new issues tend to be very strong. There tends to be a good amount of cash being invested in the market. Anecdotally, we're hearing about institutional investors allocating more to this space as well. So the demand-supply dynamic appears to be in a good place at the moment.
You already mentioned that, of course, diversification is crucial. Still, are there maybe particular industries or subsegments you find attractive or really interesting, also with a long-term view?
We are a fundamental investor and very bottom-up led in our process. So we tend not to have top-down macro themes or even sector themes that are dominating what we're doing. We tend to be more driven by the individual story of the issuer. But I would say that our focus at the moment, particularly given where we are in terms of spreads, is to really focus on the downside risk at the moment. So thinking about what would happen if funding markets were to shut unexpectedly. So that means a focus on cash flows, a focus on liquidity, an understanding of how corporates are going to be able to refinance their debt. So the access to the local market, for example, is a very helpful diversifier of liquidity in that respect. We are, I think, a value-driven investor, so we're always looking for parts of the market that are out of favor or where valuations are becoming more interesting. There are parts of Brazil and Turkey, I think, at the moment, which are beginning to look more interesting. But we also recognize the need to balance that with some stability in portfolios. So Asia, for example, on the face of it, can look quite expensive, but it does also provide this stability in case the market does turn. Now, one very important factor we try and focus on in our management is beta, and trying to keep the beta of our portfolio below 1 to try and ensure that when the market does turn down, we are outperforming in that scenario. And so we're also thinking about how diversification comes into the mix and how we can look in the less well-followed parts of the market to try and improve that beta effectively and keep that downside market profile that we have as kind of positive as possible. I think our clients really kind of appreciate that characteristic of our portfolios in general.
Yeah, I mean, risk management is pretty crucial, also very important to institutional investors. I would like maybe in our last segment talk with you about the investor's point of view and how emerging market debt strategies can be integrated within an institutional investor's portfolio. What would your approach be in that case?
Well, I would say the key word is diversification, really. For investors in Europe and Germany or wherever, really, that are focused currently on developed markets, we think emerging market debt offers a really fantastic opportunity to diversify exposure geographically, potentially by currency as well, but to do so with a very attractive yield and carry that should effectively enhance the risk return of the portfolio overall. So there are, I think, lots of reasons to be asking yourself the question, how much of this should I be adding to portfolios? I think we tend not to see it as a core holding, but more of an alpha generator on the side of a more developed market focused fixed income portfolio.
You mentioned in the beginning, Vor, that emerging markets are often, there's a misconception about them being high yield, high risk, and they're more investment grade. Can you maybe, from a investor perspective, go more into detail about that, how they should treat emerging market debt within their portfolio?
Well, I think the point about quality is an important one, particularly in Germany, because we have a number of clients who are required to have ratings constraints on their portfolios, the VAG compliance rules, BaFin rules, and as such, we have to be very aware of ratings in our EM corporate portfolios in particular. And so I think it's an asset class that lends itself very well to that approach, because we have a high quality, predominantly investment grade universe that we can build diversified portfolios from. We can then supplement that with some off benchmark exposures, the local markets that I mentioned, usually a relatively small overall component of the portfolio, but an important diversifier and yield enhancer. And build these diversified portfolios from the bottom up in an unconstrained way. We think it's important not to focus too much on benchmarks, because to do so, I think, means that you are, to some extent, delegating your allocations decisions to the benchmark providers who, sometimes have some unusual rules or rules that we don't necessarily agree with. For example, our definition of emerging markets in the Franklin Templeton fixed income team is low and middle income using GNI per capita, whereas many of the benchmark providers include high income countries in their definition of EM. So Gulf countries or South Korea, Hong Kong.
Why did you decide it?
It's been a rule that we've had in place for a very long time, and it's actually been the benchmarks that have changed rather than us. We feel that this focus more on low and middle income represents a truer definition or representation of emerging markets.
Yes.
And if you're in the high income countries, you're arguably more in developed markets. And I think by extension, spreads tend to be lower in that part of the market, and duration tends to be longer. And therefore, you're more sensitive to US Treasury duration risk. We prefer to have duration relatively short where possible, and that allows us to build a portfolio that has higher carry with shorter duration, which through the cycle should give a good risk-adjusted return.
As a last question, maybe ESG, well, I wouldn't say it vanished, but maybe it got less important within the last years. Still, how can ESG be incorporated within emerging market debt strategies?
Well, we're still very committed to ESG within our EM corporate strategy, which is an Article 8 fund. There's kind of two answers that in the research part of the process, we have ESG embedded into the process. So the analysts will be looking and scoring the credits that they look at based on a proprietary approach dependent really on the most material factors for the sector they're looking at. So each sector varies. There's a qualitative element to their analysis, and then also engagement, very important for us, because as I said earlier, with EM, it's not always the starting point that's important, it's the improvement that we're trying to encourage. And so by engaging, particularly with the laggards, as we call them, within each sector, we can try and encourage the weakest ESG profiles to improve, whether that's from a carbon emissions perspective or otherwise. So that's the research part, and then at the portfolio level, we're excluding parts of the market that we don't deem to be appropriate for ESG-focused funds, and that would include, for example, CCC-rated, MSCI-rated securities and other issuers that have failed the UNGC, for example. So quite a long list of exclusions. We're also trying to help encourage the growth of the ESG-labeled market by buying green bonds, whether available, ESG-labeled bonds when issued. That's a part of the market that showed some really interesting growth a couple of years ago, but has leveled off a little bit. But we're really just looking to try and continue this ESG momentum, because we think our clients want it ultimately.
Thank you for your time, Robert, and thank you for your insights. Und vielen Dank, dass Sie zugeschaut haben. Ich hoffe, Sie bleiben uns gewogen und bis zum nächsten Mal.